Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United Rentals, Inc. annual report. United Rentals offers a wide range of equipment rental services through its two segments, general rentals and specialty. In the general rentals segment, the company provides general construction and industrial equipment such as backhoes, skid steer loaders, forklifts, earth-moving equipment, and material handling equipment. This segment also includes aerial work platforms, tools, and light equipment. The specialty segment focuses on trench safety equipment, power and heating equipment, fluid solutions equipment, surface protection mats, and mobile storage equipment. This segment serves construction companies involved in infrastructure projects, municipalities, and industrial companies. In addition to rental services, United Rentals also sells new and used equipment, including aerial lifts, reach forklifts, telehandlers, compressors, and generators. The company's offerings also include construction consumables, tools, small equipment, safety supplies, and parts for owned equipment. Furthermore, United Rentals provides repair and maintenance services to its customers. The company operates in several countries across the globe, including the United States, Canada, Europe, Australia, and New Zealand. The significant increase in United Rentals, Inc.'s URI stock price over the past year can be attributed to a combination of factors. One major contributor was the company's strong financial performance, particularly its robust first quarter 2025 earnings, where revenue surpassed estimates at $3.719 billion. This was followed by solid second and third quarter performances, with United Rentals raising its full-year guidance for total revenue, adjusted EBITDA, net cash provided by operating activities, and free cash flow. The company's strategic capital allocation also played a crucial role in driving up the stock price. In April 2025, United Rentals introduced a new $1.5 billion share repurchase program, demonstrating its confidence in its financial position and commitment to shareholder returns. This was further reinforced by an increase in planned share repurchases in July 2025, bringing the total to $1.9 billion. In addition to these factors, positive analyst sentiment also contributed to the stock price appreciation. In January 2026, UBS upgraded United Rentals stock rating from neutral to buy, with a price target of $1,025, citing anticipation of a rebound in U.S. non-residential construction activity. The acquisition of H&E Equipment Services in January 2025 also had a positive impact on the company's stock price. The transaction was valued at approximately $4.8 billion and was expected to expand capacity in strategic U.S. markets and be accretive to United Rentals' adjusted earnings per share and free cash flow. Overall, the combination of strong financial performance, strategic capital allocation, positive analyst sentiment, and favorable market outlooks drove up United Rentals, Inc.'s stock price by over 17.72% in the past year. United Rentals, Inc. market capitalization of $58 billion is significantly larger than the average industry peer of roughly $8 billion. This shows that United Rentals, Inc. holds a significant advantage in their industry. United Rentals, Inc. trades at a higher price-to-earnings ratio of 23 times and a higher price-to-book ratio of 6.4 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The net income and profit margins of the company underwent significant fluctuations over the years. In some years, such as 2018 and 2020, the net income increased by 13.6% and $644 million respectively. However, in other years like 2022 and 2023, it decreased by -$81 and -3.1% respectively. The profit margins also experienced changes, with an increase of 38% for equipment rentals gross margin in 2018, but a decrease of -190 basis points in 2022. The reasons behind these changes are varied and complex. Changes in customer demand and mix had a significant impact on the company's performance. Fluctuations in oil and natural gas prices also affected demand for services and products. The cyclical nature of the industry and its customers' industries contributed to the volatility in net income and profit margins. Additionally, the company faced increased costs due to fines and regulatory compliance issues, which further impacted profitability. The impairment charges, changes in useful lives or salvage values of rental equipment, merger termination benefits, and intangible asset amortization also played a role in shaping the company's financial performance. These factors highlight the challenges that companies operating in this industry face, making it essential for them to adapt and respond to changing market conditions. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data provided on pages 34 and 47 of the report reveals a consistent trend of increasing net cash provided by operating activities over the past 3 years. In 2023, the company generated $4,704 million in net cash from operating activities, which increased to $4,546 million in 2024. However, there was a slight dip in 2024 compared to 2023. Nevertheless, the trend reversed in 2025, with the company generating a significant increase of $644 million in net cash provided by operating activities. This upward trajectory is a clear indication that the company is successfully managing its operations and generating sufficient cash flow to support its growth. The positive operating cash flow is a crucial metric for any business, as it reflects the company's ability to cover its expenses, invest in new opportunities, and reward shareholders. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the debt level increased due to an ABL facility size increase and the issuance of $1.5 billion in senior notes. However, this trend was reversed as total debt decreased by $823 from 2023 to 2024. Furthermore, average month-end debt outstanding and maximum month-end debt outstanding also saw significant decreases. In terms of interest expenses, there has been a notable increase due to rising market interest rates. The company's interest expense and debt service obligations have increased, resulting in higher interest expenses. Despite this, the amended term loan facility and issuance of debt with a fixed rate of 5.3/8% may have reduced interest rate risk. However, interest expenses have continued to rise, increasing by $13 in 2025 compared to the previous year. The data suggests that while there was an initial increase in debt level, it has since decreased significantly. Conversely, interest expenses have consistently increased over the past few years, indicating a growing financial burden for the company. The company's performance varied across different segments and regions. On a positive note, the specialty segment has been a significant contributor to business and revenue growth, with an increasing portion of sales coming from this area. Additionally, there was a notable increase in specialty equipment rentals by 12.2% year-over-year and new equipment sales by 23.4% year-over-year. In terms of regions, North America performed well due to its strong brand recognition, geographic diversity, and customer base. This region's success can be attributed to its established presence and reputation. However, not all segments and regions fared equally well. The general rentals segment in the Northeast division struggled, although specific details were not provided. Furthermore, there was no significant change in general equipment rentals, rental equipment sales, contractor supplies sales, and service and other revenues compared to 2024. Regions such as Europe, Australia, and New Zealand had a smaller presence, making it difficult to assess their performance. Management's outlook for the company is one of strategic focus on growth, profitability, and debt reduction. In the short term, they aim to complete a $2 billion share repurchase program by Cone 2026 while prioritizing debt repayment over dividends. Long-term goals include driving revenue growth through margin expansion, operational efficiencies, and cross-selling adjacent products. Key strategies involve leveraging technology advancements to improve efficiency and customer experience, investing in AI solutions for product development and operations, and focusing on customer service differentiation. The company also plans to pursue strategic acquisitions to drive business growth and expansion. The industry outlook is cyclical, with fluctuations in revenues and operating results due to seasonal rental patterns. However, the company expects continued growth in equipment rentals driven by recent acquisitions and other factors. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out to its investors over the past 3 years, with totals of $464 in 2025, $434 in 2024, and $406 in 2023 per share. In addition to paying dividends, the company has also been actively buying back shares from the market. In 2025 alone, the company repurchased a total of $1.65 billion under its share buyback program, with overall share repurchases totaling $1.9 billion for the year. This demonstrates the company's commitment to returning value to its shareholders through both dividend payments and strategic share purchases. Concerns about inventory buildup and supply chain disruption. There are indications that the industry may be facing potential issues with inventory buildup and supply chain disruptions. On several occasions, it has been noted that there are concerns about supply chain disruption, pages 1, 11, 16, 18, and 30. These concerns range from limited impact to date but potential for more severe disruptions in the future. Additionally, there are also concerns about inventory buildup, particularly on page 1. Furthermore, indirect mentions of inventory buildup can be found on page 45 through purchase obligations and advance purchase orders. While these issues are not widespread across all pages, they do suggest that the industry should be aware of potential problems. That concludes the financial summary for United Rentals, Inc. Feel free to comment below, and I will be happy to answer them when possible.